Hey everyone, happy Friday! Thank you for joining Finance Friday Live. We do this every week at 4 o'clock Eastern, 1 o'clock Pacific Time. We are on Twitter at Nova Wealth Management, MGMT. Follow us on Facebook. Like us on Facebook, I guess is the technical term. See, I'm still learning. Hey, Johnny. Subscribe to our YouTube channel. We do little 90-second tip, fast videos on there. And then also we have a podcast, the Nova Wealth Show. We do big shows on there and interviews as well that you can find on the Woodage Network. So today, a couple weeks ago, we did all about the tax bill. And I'm a financial planner, so I know enough to be dangerous, but I'm not the expert. So we had so many questions that I wanted to reach out to my CPA, wonderful expert. Thank you for being here, Tom Wanderon. He's actually in my building upstairs, tax and financial strategist. I'll have him tell you how to get a hold of his firm throughout the live. But we're going to answer your questions, all about any tax questions at all, and then, of course, about the tax bill. I have several questions that we want to get to. So thank you for being here, Tom. Why don't you give just a little bit of background, like just a couple minutes, on your firm and what you guys do?
Okay, so my name is Tom Wanderon. Name of my firm is Tax and Financial Strategists. I am not a CPA. CPA is a person who is an expert in accounting. My license is with the U.S. Treasury. I am what's called an enrolled agent. So I am supposedly an expert on federal taxation, and hopefully I can give you some insight into the new tax laws.
People are joining, do you see?
Yes.
Okay. So, one of the first questions that we had come in, and of course, like I said, ask your questions. And if you can't think of your questions now, feel free to go to my website, novawealthmanagement.com, and go to the Contact Us page, and you can send me questions through there, which is where a lot of people sent questions. Email me directly, or you can simply message in the comments here, and we'll answer them. Okay, you ready? Let's get started. So, the first one was about this 20% write-off on pass-through income. So, it's my understanding, I didn't even mention this a couple weeks ago on our updates on all the new tax bill, but pass-through income, first of all, I want you to explain what pass-through income is, like who it affects, and then what the new tax law, the 20% write-off, means.
Okay, ordinarily, pass-through income would have been income that was reported from partnerships and S corporations and trusts, where a participant, a partner, a stockholder, a beneficiary,
a business
of a trust,
owner, right? Like just a business owner.
Well, we'll get to that. But that would be pass-through. The pass-through income is the income that's being reported from a pass-through entity.
So another entity.
That would have been would have been identified as a subchapter S corporation, a partnership, or a trust. What they're talking about now, what they're calling pass-through income, that is subject to this 20%
write-off.
Write-off.
It says write-off is what it says.
Okay, it's a deduction.
Okay,
and,
isn't that a write-off?
Well, yes, and it is actually connected with any business, not only a partnership or an S corporation or a trust, but it could be a rental property, a Schedule C individual business.
Okay.
So just about any business entity that qualifies.
So if you're not sure, you could pull out your tax return and see if you had a Schedule C, essentially?
Right.
Because a lot of people aren't sure.
That's a business owner. If you are an individual business owner, you are
Schedule C
you
income.
may get this write-off or this deduction.
Now you say you may get this write-off, so there's levels, right?
It's subject to an awful lot of calculations.
What ifs?
Okay, well,
that's shocking with the IRS. That's complicated.
Yes.
Right. So if you're just joining us, so we're going over any questions on tax in general and the new tax laws. So.
So in regard to this, though, I don't think that I could give you every single what if today, but some of the qualifications. If
Okay.
you okay.
Yeah, just give some examples.
Well, the people like Amy and myself are not going to get full benefit of this 20% deduction. Our fearless leaders in Washington chose to make some exclusions for people
Professional services?
Right, professional services.
Okay.
And they specifically people in the financial business, accountants, medical practitioners, attorneys, engineers. For some reason, engineers and architects were excluded. But if your business income is primarily from professional services, you get the 20% up until when your income gets to be $315,000.
Okay.
And from $315,000 to, if you're married filing jointly, to $415,000, approximately $415,000, the benefit phases out.
But it's okay. I guess it's so crazy how complicated it is, but it's literally a 20% deduction. So, for instance, if you have $300,000 in income, it's a $60,000 deduction.
Correct, but there's
That's
some other
nuts.
qualifications.
Right. No, I know.
If you have an S corporation and you as an owner didn't take any salary,
Right.
there will be a reduction of the 20%.
So this is good for anybody that gives advice to business owners too. So I mean, like, I know Sally is definitely an advisor for her clients at a bank, and so it's not just if you're not a business owner, this doesn't apply to you. If you give advice to anybody that is a business owner, or you work with business owners, or somebody in your family is a business owner, this applies to everyone. That you should be letting them know, because as I just said, that's a big tax
This
cut.
is actually, and remember
This is a good thing.
Okay, why the reason?
Let's say what's good and what's bad.
The reason that this was done is that
Oh, that's a good one. Yeah.
Okay,
What's the reason?
A large deduction of tax was given to corporations,
Okay.
mainly public corporations.
Okay.
Their tax rates went from 35% to 21%.
Okay.
And
That's why they're giving out bonuses.
it would
some
not
of them.
right, but it would not have been fair for only large corporations to get a
some
tax
sort of
benefit
Okay.
without giving benefit to small business owners.
Got it. Okay,
And
that's
that's
great.
what this is all about.
So that was about the 20% write-off that we get, or deduction on, well, I shouldn't say we, because we don't get it. But
Well, you'll get
if you-
some.
Okay,
Maybe.
good. I'm phased out. Okay, so the second question is, on 401ks, so like we manage a lot of 401ks, but also employees to 401ks have these questions. So it was rumored, right, for several months before the bill, and it was kicked back and forth, on if 401ks would be affected in their deduction or how much you could contribute. But I'm also getting questions from business owners. Was anything in 401ks affected?
Nothing in 401ks were affected. The deferral for a person under 50 is still $18,000,
Right.
and there is all of the
All the limits stay the
limits.
But what about like if a company normally does like a match like that, they're still going to probably do, like, nothing changes the match.
Nothing
or the
changed.
profit
That-
sharing was another question I got. Like, was my profit sharing going to change now?
it's
Because
not.
okay.
It's not that
Good.
nothing, and there was
401ks.
no change whatsoever. The 401ks.
Hey Lisa, thanks for joining. So we're talking about taxes again because we got such an overwhelming response 2 weeks ago. I had all these questions come in about not only the new tax laws, but I think it just spurred a lot of questions on tax in general. So ask your questions. So one of the questions was around 401ks. We just answered that. Nothing changes with your 401ks. Also with the 20% pass-through income write-off, that's a pretty substantial write-off for anybody with pass-through income. You mentioned rental income, business owners, small business owners, Schedule C income. Another one is explain how, so the standard deduction was raised.
Standard deduction was
So
raised.
that affects everything that we used to itemize for. So like charitable deductions, right?
Correct.
Not retirement deductions. That's above the line.
Okay, so what?
But charitable deductions are affected. So explain that.
Well, they're affected in the fact that the standard deduction was raised from $12,000, approximately $12,000 for a married couple, to $24,000.
Right, so it's doubled.
And along with this, they limited the deduction for taxes. If you look at the tax line on your Schedule A, only a maximum of $10,000 of taxes are deductible from here on in.
You mean like state income taxes?
That's correct. Maximum state income taxes or real estate taxes. The maximum deduction now.
So you're talking like a mortgage? I'm like choking here.
On real estate taxes on properties, regardless of whether you have a mortgage.
Okay.
The maximum deduction that you're going to take in that category, starting in 2018, or when you file your 2018 tax return in 2019, the maximum in that category is $10,000.
Okay.
For
everybody?
For everybody.
Okay.
Miscellaneous itemized deductions, including tax preparation fees,
yes, no,
are
I know.
no longer deductible.
Advisory fees are no longer deductible.
Advisory fees are no longer deductible.
Yes, which I covered last time a couple of weeks ago.
So to discuss how this affects charitable contributions.
Yes.
Charitable contributions are part of your itemized deductions. There is some, concern in charitable organizations that because people will not be getting the benefit of the charitable contributions that they might have gotten on their tax returns in the past, that
that they might get less.
That they might get less. And I urge anyone who wants to make charitable contributions to continue doing so.
Right.
Something that you can keep in mind if you are retired and you are getting retirement benefits and you do make charitable contributions. Think about making your charitable contributions from your retirement, from your IRA. So your required minimum distribution can be made directly to your charitable organization. Now,
not like take the check from your IRA and give it to the charity. You have to give it physically directly to the charity. And it's then you avoid the tax on the RMD, correct?
That is correct. And
so that's big. That is big. For anybody over 70 and a half, you have to take money out of your IRAs.
That's
and if you can give that to charity, you can avoid those taxes.
And you can also, if your income is limited to a small amount of interest in dividends or your IRA,
like Social Security and retirement income, essentially.
Well, this actually then reduces your
taxes.
It reduces your total income and your adjusted gross income, and possibly your Social Security benefits won't be totally taxed.
Right. So it affects taxes twofold, actually. If you just take your required minimum distributions from your IRAs, move them directly to charity, what he's saying is not only will that money that you took out of your IRA not be taxed. Let's say you have to take out $10,000 from an IRA. Typically that $10,000 would be taxed at your income tax rate. So not only would you avoid that, but then also that $10,000 typically counts as income on your tax return. And if you have more than a certain amount of income, then they tax your Social Security. So if the $10,000 is now not taxable and it drops you back below the amount where your Social Security is now not taxed, that's a great thing. So it's a double benefit if you use your required minimum distributions from your retirement accounts to give to charity. That's awesome. That's a great one.
One other, if I can just
go ahead.
Give you one other clarification on charitable contributions.
Okay.
Under the old
law, there was a few questions on charitable contributions, so we're just kind of covering them all.
Under the old law, there was a 50% limitation, and what that means is that, let's just say your income, adjusted gross income was $100,000.
Your AGI.
And you made $100,000 in charitable contributions. The maximum charitable contribution that you could take as an itemized deduction would be $50,000.
Okay.
And you didn't lose the balance; it got carried forward. Under the new law, they've made it 60%. So under that hypothetical example, if you had $100,000 of adjusted gross income, you could then deduct $60,000,
and then the balance
would still be carried forward.
Okay, good. That's great to know. Okay, good. So if you're just joining us, we're talking about all things taxes again because we got so many questions 2 weeks ago about taxes. So we brought in Tom Wanderon of Tax and Financial Strategist to go over all your questions, and we're now getting into more and more questions. We've already talked about 401ks and how they were not affected. Got a phone call. A little bit of a skip there. It's okay. Just my kids calling from home. We talked about charitable contributions, a lot about charitable contributions. Watch the video back if you missed it, because we went over several things on charitable contributions. And then we also talked about the 20% pass-through income write-off. 20% of the pass-through income is you're able to write that off. So, okay, moving on. I want to be very respectful of your time. Mortgage and medical bills changed. So I want to clarify, I had a question in general about what the mortgage interest deduction was. I know that's very basic, but not everybody knows about what the mortgage interest deduction is in general, and then how it changed, and then medical bill.
Okay,
well.
so we're talking about the mortgage.
Yes.
Under prior law, mortgage interest was deductible up to $1 million. So in other words, of debt.
So if your mortgage was $1 million,
well,
not the interest.
Right. To give you an example, let's just say that you had
I have a whiteboard. Do you need a whiteboard?
No, I think we can. I think I can do it. If you have a mortgage, a home that you paid $2 million for,
okay,
and your mortgage is and the mortgage was $1.5 million, only the interest on $1 million was deductible. $1 million
would be deductible.
So, for instance, if your mortgage interest was $150,000, 2/3.
That'd be a lot.
Well, I'm trying to come up with something that I can make a hypothetical example on.
Okay, got it.
So in that hypothetical example, only $100,000 of the mortgage
deductible.
Interest would be deductible.
Yes, I understand.
Very
good.
On mortgages that were in effect prior to the act, that's still in effect. So if you had a mortgage.
So this is only for new mortgages moving forward.
New mortgages moving forward, the amount is $750,000.
Okay.
So only the interest that relates to $750,000 of mortgage is deductible.
So when you're trying to figure out how much you should put down on a home, if you can get it under $750,000, your loan, if you can get your loan under $750,000, that might be something you want to consider, because the interest would only be deductible on $750,000 worth of debt moving forward. So all of us that have mortgages now, you're saying we're grandfathered into the old.
We're grandfathered into the old in regard to the.
Not that I have a mortgage that's $2 million, but.
Okay, and so along with mortgage interest, then there was the home equity line situation, and home equity was pretty much eliminated. Bear in mind that
home equity interest deduction was eliminated.
Home equity interest deduction was eliminated. That was the extra $100,000 of interest that they would allow you to take a deduction on. Bear in mind when you that those of you who have used home equity for maybe other purposes, to invest in your business, the interest would be deductible on your business return rather than on Schedule A. If you used the equity loan to buy or upgrade a rental property, that home equity interest would still be deductible on your Schedule E rental property expense. And
so it would apply towards what you actually used it for.
Right.
So what if you used it to add an addition onto your home?
Okay, there is a difference of opinion among
or upgrade a kitchen. I had a client just this morning. I redid my kitchen.
Okay, there is a difference of opinion among advisors, and I think we will get a clarification from the IRS on this. But there is another code section 162 that spells out how home equity interest is deducted.
Okay.
And it is my opinion that if the mortgage interest, equity interest, was used for either acquisition purposes or to upgrade your home
in any way,
that it would still be deductible. That is my opinion. And that's
funny because there is still like opinions floating around. Like as I was getting questions and you try to look up answers, there's different opinions on things. So what is fact?
But if it was used to pay off credit cards, to take a vacation,
Consolidate debt is another big equity
to
line.
buy an
reason.
automobile, it
Right.
is not deductible.
Okay,
But,
good. Your home equity
but
lines, and a lot of us got home equity lines, especially I know when I worked in the bank. People got home equity lines just like what you
Right.
said, for a lot of different reasons.
But-
had nothing to do with actually putting money into the home. Even though the collateral is the home, they did it for other reasons. Debt consolidation.
Right. Every time there's a new tax act, shortly thereafter there will be
Hey, Megan.
there'll be
Sorry you're late.
clarifications that will take place, and I think we're going to get a clarification on
Okay.
On
Very good.
Yeah,
We like
home equity.
clarification. Okay,
Okay.
good. Okay, not mortgage, medical bills. So
Medical-
medical bills, before it was
they-
like over 10% of income, or
well, 10% of your medical. You have to be pretty sick to be able to get a medical deduction. But
well, and
if
how does
you-
it work? Because you have a deductible, so it's really just your deductible portion you're talking about, or
Right.
just if you didn't have health
or
insurance?
if you didn't have health insurance
Okay,
at all.
okay, got it.
Your medical expense deduction, the deduction you got, your medical expenses would have to exceed 10% of your adjusted gross income. So if your adjusted gross income was $100,000,
Have to exceed 10
your
grand.
would have to exceed $10,000. That
Which
was
with all these deductibles nowadays, that's pretty possible.
it was reduced to 7.5 for 1 year only.
Okay. Oh, for 1 year
1 year
only?
only.
Oh, and that's the other thing. I don't even know if I mentioned this a couple weeks ago, but all these changes, don't they all just go into effect until 2025?
Yes,
And then they revert back to the
and
old?
then they sunset. Yes.
Oh my goodness.
If they're not and of course, we've been promised that we're going to try to extend all of this
It's
stuff.
okay, I forgive you.
But
Yeah,
but
exactly.
if it doesn't get extended, it will expire in 2025.
Okay, we'll see if it gets extended. So we're going over all things taxes again because we got such overwhelming questions. I got all these questions for Tom on tax in general, but also the new tax laws. So we just covered, we covered a lot. We covered, and I constantly have to recap because there's people joining. So we
And
have
I
the
may have to read some of my notes too. I have a
that's
whole
okay.
recap of this.
You have a
here,
whole packet
if I can
here.
find it. Yeah.
your general, like things that changed. Because I probably missed a lot. I went over some of the fun things. So we have the 20% write-off on anybody that has pass-through income. Did anything change? I noticed some of the people tuning in might be paid on 1099, so subcontractors. Did anything change on that?
Okay. Well, there is going to be. You have to remember what this 20% deduction is sort of very beneficial to people who own businesses of any kind.
Right.
And it's detrimental to employees. Well, and that employee, if you are an employee getting a W-2,
Right.
you're not getting any part of this 20% deduction.
No, but how is that detrimental if their situation just stays the same?
Well, because they
They
don't
just
get
don't get part of the benefit.
They don't get the 20. They don't get any of the 20% deduction, even
hopefully
with
the
its
owners-
limitations. So
Yeah.
what is going to, in my opinion, what is going to happen is that they're going to be a bunch of people that may want to not be employees any longer and be paid as subcontractors.
Oh,
And,
I see where you're going with this now.
And so this may wind up becoming a problem to the Internal Revenue Service because they're
see.
constantly fighting this
So is 1099
subcontracting.
income, is that considered pass-through income or
Your
no?
your 1099 income is business income.
So
And
you have to be a business owner though.
If you have a 1099, you are reporting, most likely you are reporting that income on a Schedule C business,
Right.
okay, an individual proprietorship. Maybe you're taking some deductions in regard to that automobile,
Okay.
office expenses, things of that nature. Maybe
Yeah, right.
You could be. Remember that you could be a self-employed painter,
Right.
that you
Self-em-
get 1099s. That business does get the part of 20%
Okay.
deduction.
But you have to, okay.
So
Pass-through income meaning, she said pass-through income, so she just joined. Pass-through income meaning business income or like 1099 income because you're a business owner and you get paid via 1099. So that's considered pass-through income. So as opposed to like W-2 employee income.
Right.
Easier way to say that.
Right. And what I think is, I think many people who can try to, many people will attempt to become subcontractors.
Okay. Okay, so we talked about medical bills. I did have a random question. What do you think out of this tax bill, this is where you might need to refer to your notes, is most beneficial to the most people? Like, what applies to the most people?
Well,
I know what I think my answer would be, but I'm not an expert.
Well, your tax rates are being lowered.
The brackets, right?
Tax rate.
Yeah.
Your
agree.
rate.
Not that my opinion matters.
Right. No, you're absolutely correct. The rates.
The percentage.
The percentage went down, and
Yes.
your brackets. And you get into the higher bracket at a higher amount of income now.
Got
So
so overall, as a percentage, you're just going to be paying less tax. That's just the fact.
okay.
Less income tax.
Anyone who is working, who is receiving taxable income,
Right.
should get some sort of a benefit, contrary to what you may hear.
Unless they had all kinds of crazy.
You should get some kind of a benefit,
Right.
because your taxes will go down to some degree.
Okay, good. That's good. That's good news. You see? This is hopefully good news. There are some negative things, obviously, too, which probably should have been a question. So what's the most negative thing that will apply to the most people?
Well,
Let's ask that question, since I didn't have that here. But
well, if you live in a northern state, you no longer can deduct more than $10,000 of taxes.
Right.
This is sort of a big deal.
You're talking about the state income tax
Yes.
again.
And the ability to write off your miscellaneous itemized deductions, which includes advisor fees,
Tax planning fees.
tax preparation fees, attorney fees for business purposes, for trust fees, things of that nature,
Right.
are no longer deductible.
I said that I was going to now take the advisory fees from IRA accounts, because if I deduct the fee from the IRA account, they're not going to code it as a distribution. In a sense, they'll avoid tax on it, right?
I'm not sure you can do that. We may want to give that a second opinion. If
it's not coded as a distribution, I'm right. The question is it going to be coded as a distribution?
Yeah, you want to make sure it's not going to be coded as a distribution. Obviously, advisor fees for your IRA accounts can be paid from the IRA.
But you don't think the fees from other accounts?
I am suspect that you can take an IRA fee from a
non-account and deduct it all from the IRA. Okay.
I'll give it a shot. I would be careful with that one, and I will. And
I could call the IRS. The problem is you get a different answer every time you call the IRS. They don't know either.
I'll give that some research for you and let you know.
Great, that would be great.
But other detrimental things, if you are in business, you're getting a benefit from this so-called 20% qualified business deduction. That does have some limitations.
Yes.
But some of your some things were taken away. Business promotion and entertainment has been limited.
Okay.
So
entertainment is in like when I take my clients out to dinner.
Well,
entertainment,
business meals are still deductible.
Okay.
Entertainment.
So if I take them to a football game.
Football games no longer deductible.
Okay.
Baseball games.
Good thing Jim bought season tickets to the Browns last year.
Well, okay. I for one, I do an awful lot of boating. I take
your
in
clients.
the past I take clients fishing. Those I cannot deduct the cost of my boat, but if I'm entertaining or a client on the previous law, if I was entertaining a client on my boat, I could deduct that day's cost of fuel to some extent.
Right.
The bait and the supplies that I buy, no longer deductible.
Oh, okay.
So there are some things that are going away.
What if your business is entertainment? So I guess the reason why that comes from is I have actually 2 clients that are a captain of like a yacht.
That's okay. Well, that's
their business, though. Even though their business is
that is their
entertainment.
business.
Okay.
Yes.
Okay. Good. So you know what? I just noticed because I keep recapping all these questions. But what I'm going to do is post all the questions in the comments. That way everybody can see. Like maybe I'll even do a timestamp or something of when the questions were, so you can go back to directly to your question in the live and get the answer to your question instead of me recapping like every 2 minutes of what the questions are. So really quickly, why don't you tell people how they can get a hold of you, and then we'll wrap it up with your final thoughts. Tell people how they can get a hold of you with your firm.
Okay, I'm in the same building as Amy.
As me.
Name of my firm once again is Tax and Financial Strategist. Telephone number 239-405-8395.
And I'll post that in the comments too, actually. So any final thoughts that you wanted to add? Those were we had like 8 questions. And there were several questions within the topics. We did. Well, actually, I had one more question, and this applies to anybody that is an accountant, probably anybody that's in the services industry, but I got a question from somebody that is an accountant that says, how is this tax bill going to affect your business? Because he's an accountant. And so he said, how is this going to affect a tax preparer's job?
Okay, well,
and that was a very specific question, but we can answer it.
Okay, well, most likely, I would expect that...
Not much, right?
No, I would expect in the first year or 2 years of any new tax act that people in my profession should do a little bit better, because you're an individual rather than getting a TurboTax program
will go to a preparer.
Might come to a preparer, but once they've got it under control, it's going to go back.
It'll die down.
And you
don't think the writing off of the tax fees will affect anybody?
Well,
because your fees aren't astronomical, so it's not like it made that big of a difference.
Remember that, at least in my business, the majority of my clients are business owners.
Right.
The tax preparation fees.
We have a lot of business owners too.
For your tax preparation fees are still deductible in your business. They're not. It's not deductible as an itemized deduction. So if you have
so it's an expense in your business, it's still deductible, just not as an itemized.
Accounting and tax preparation for business purposes is still deductible on your business tax returns.
Oh, well, that's good to clear up. Advisory fees aren't, though.
I'm sorry.
Great.
But maybe you want to get clients to open businesses.
There you go. That can save them a lot of taxes.
And then get
them to open a business and be a business owner.
Would be deductible in the business.
There you go. Okay. That's good. That's good. So thank you so much for joining. Again, instead of doing all the recap now, I'll just go ahead and post the questions in the comments, and then you can go back and look at the specific questions to see if they apply to you. And if you have more questions, I'm happy to reach out to Tom afterwards. So send us more messages if you want. Go to our website, novawealthmanagement.com, and contact us from there. Any last thoughts that we didn't get to that you want to add in?
Send the questions to Amy, and we'll try to answer them as best as possible.
Thank you so much for joining. Have an awesome weekend. We appreciate it. See you next week.